what we're getting ready to learn. Hi, Latika. Welcome back. Haven't seen you in a while. It's good to see the Empire family, the Arab family. How's everybody doing?
Thank you.
You
Good.
good? All right. I have J and Pen for some reason. Um, all right. I think this works better. So it is almost noon. We're going to go ahead and get started. Um, I'm conscious of everyone's time, but I'm also excited to have Miss Jan Robinson here, and for her to share with her knowledge base, having worked at the IRS as a revenue officer. So, what I'd like to do before we jump in is to go over some housekeeping, um, so that you'll know what we're doing on our side. I'll always encourage people to put your information in the chat. It's all about collaboration. Put your email, contact information, your areas of expertise. Our goal is to continue to create a collaborative community. It's all about each one, teach one here. Also, I'm excited. We still have two more winners that kicked off 2024. Miss Bowie actually told me this week she won a second contract. So, again, the methodology works. It's about everyone applying what they've learned through the program. Tomorrow, please encourage those that you may know that might be interested in getting into this space. I'll have an information session that's going to start tomorrow at 9:30 a.m. And then I'll have another one next Saturday. We also have our self-pace for those who want to go at their own speed. I have pre-recorded the sessions, and you also have access to the office hours and lab session. So again, the goal is to make sure we can get as many small businesses in this space for 2024. I'm excited about who's doing the training for our February cohort, which will start February 28th. Miss Jones will be training you guys. She has almost 34 years of federal experience, specifically working with 8A companies under SBA. So I'm excited. Again, if you know someone that is struggling and don't know how to get into this game, it's key and critical that you continue to share what we're doing over here in the community. Also, I've partnered or sponsored with GovCon, the formula. That's going to be May 2nd here in Riverside Epic Center. Again, it's about us coming together. It's going to be set up as a small business industry day, but more importantly, you'll be able to touch real people, the billionaires, the millionaires that are actually going to participate and continue to educate. As always, go to our YouTube page and make sure you subscribe. With that being said, I think I've covered all the housekeeping notes. And I'd like to go ahead and jump right into our topic today. But before we jump in this topic, I always like to go back and get background on people on how they've gotten to the point where they are, and walk us through your journey. I'm excited because Jan is also a current student taking our program. And when I heard her background, I was like, we need you. haven't have had the experience with a revenue officer. So, Jan, where are you from? And give us a little background about who you are.
Well, thank you, Ms. Paula, for this opportunity, and hello to everyone. I am Jan Robinson. My home state is Georgia, and I love it. I miss Georgia. It's always on my mind. But I grew up in humble beginnings with two parents that only had one girl. So I have five older brothers, so I learned a lot from them as well as my parents. I went to college. I started out my undergrad in a co-op program at Payne College, and then I went to Georgia Tech. Shortly after that, and in between, I joined the United States Marine Corps. Ended up in California, um, lived in Japan twice, then came back to California. My job sent me back here, and I've been here actually longer than I lived in Georgia. Uh, from there, once I got out of the military, I started working at the nuclear plant, and it's in San Onofre. If any of you know anything about California, it was a San Onofre nuclear power plant. And I worked there for a little bit.
In
You
what
get burned out.
capacity? What were you doing?
Oh, I was an engineer. I worked in the reactors that they had there, making sure that data and everything was aligning with if we're going to do waste, if there's waste in the water, too much waste or anything like that. So I tested reactors. I did a whole lot of stuff. Wrote programs that I never knew would ever become something that's completely automated now through the core skeleton of some of the programs that I wrote. Um, After that, engineering burns you out over time. So I took a break from it, and I ended up, this friend of mine worked for the IRS. She was a neighbor of mine. And she said, "You should come and work for the IRS." And I'm like, "Well, I'm kind of scared of them." No, 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 it's totally different. So, me being me, at the time, they used to have this SF-71 application that's like 20 pages long back then. And I completed it, didn't expect to hear anything. And like 3 months later, I get a call. So I go to I start working at the IRS. And I started out as a clerk in the collection division.
I'll say, let's talk about those clerk, that 1-800, because again, that's the first line. And when I owed taxes, especially after I closed the business, and they started sending you all of these letters,
Yes.
and I called the 1-800 number, and then they just broke me down. You stole the money. We want it. Where is it? So, can you give a little bit of background of what that position was like and how you interacted with taxpayers?
Yes, the collection division. Now, there's two types. I have to put on my glasses so I can see everybody, but there's two types of areas of collection. One of them is automated collection. That's that 1-800 number that you talk about. You can call and set up an installment agreement if it's under a certain amount. You can do a lot of things on that number. However, the part I worked in was whenever you've had every chance after every chance to pay. I worked in the part where there was a bankruptcy division, there was a currently not collectible division, there was litigation, there was liens and levies. So at that time, I was just a clerk. I also worked in the part where there's trust fund recovery penalty, which I'm sure that we'll talk about a little bit later. But that part was interesting because I used to type all of these things, the offers and compromises that people make on their tax liabilities. Um, I used to input that stuff in the database, do cross checks, find like, say if there's um Paula Watts here, and then there's a PK Watts here. I used to do cross references to find that taxpayer because they'll a lot of times, especially businesses, they'll shut down their business and open up another one, and
Mhm.
then I would do skip tracing and find you.
Mhm.
So, and that was just as a clerk. And I'm like, okay, this is really interesting. I want to understand it more and see what
So
everybody else does.
how many chances do you get before it gets to you?
Before it gets to me, well, it starts with you filing your returns if you filed them, and then it'll go into automated collection after about a year.
Mhm.
So then after that year, they'll send you a first notice, they'll send you a second notice, they'll send you a third notice. When it gets to my desk, they have sent you that fourth notice, and it's the final notice.
Mhm.
Even after that, it used to be that it
Okay.
would still take them about 6 to 8 months to start collection activity.
Mhm.
But with everything being so automated now, I'm
Mhm.
sure it has sped up quite a bit.
Mhm. Okay. All
Yeah.
right. So the collection, and now, how long did you do that?
I was a clerk for, let's see, 5 years. It was 5 years.
Okay.
And then I used to want to be a technician. Now, the technician is the one that's handling your case, you calling in and you're making arrangements. And I used to want to be a technician, but then I saw this neat position called revenue officer.
Mhm.
And the revenue officers got to go out in the field, interact with taxpayers, go to their businesses, demand full payment, shut down businesses, issue liens, levies, you name it. So I said, let me try this. I did. And I tell you, it was fun, but it was scary and everything in between, because you had taxpayers that were 60 and 70 years old that were wives of people who never let them in on the finances, but because the husband has passed away or vice versa, they have this huge tax liability now.
Mhm.
So then that everybody always says the IRS is heartless. Well, they may be, but I wasn't. So I
Mhm.
used to look at each individual case and try to help them get the matter resolved. Some of them had no assets. So we used to have to write it off as a currently not collectible and follow it up, a few years down the road. And then there was some that you could do an installment agreement with. And with those I worked with, um, we would look at their financials,
Mhm.
and you would find money, but it wasn't enough to satisfy the liability. So you put them on an installment agreement. And the one thing you didn't want to do is put them on an installment agreement that they could not keep.
Mhm. Mhm.
So, you had those special circumstances sometimes.
And again, that was me. In that first business, I told you I was traumatized
Mhm.
because I went through closing the business at giving money to my attorney, my bankruptcy attorney, and he told him you need to pay the taxes because I knew that was not bankruptable, if that's a
Right.
word.
Right.
um, 5, 6 years later, that's when I started getting those notices saying that I owed $250,000 in payroll taxes.
Wow.
Um, and again, not knowing what to do, I'm going back to the attorney and telling him, what happened? You were supposed to pay the taxes. He wants to charge me additional money for research. At this time, all my money's gone. I've given it to you. So I began to defend myself and
Mhm.
started the paper trail. And when it got to the revenue officer, I said that was my angel because I went in and told the truth. She saw the documentation, and I would have never been able to pay all 250,000. So I never heard of anything being deemed uncollectible. So I guess they had another heart like you in that process.
Yes, a lot of businesses or business owners um, leave everything to their attorney, their tax attorney, or their accountant. But the biggest mistake that even individuals can make is reading what's on that paper, what they prepared about you, and taking it as gospel.
Mhm.
You do have the option, or at least this is what I used to do. If somebody had a representative, I would send the notice to the taxpayer as well as the representative. But I would send the certified notices to the representative and a carbon copy to the taxpayer. So, or the last known address of the taxpayer, so that there would not be any surprises. But that is a huge mistake that a lot of people make in terms of trusting, your attorney or your representative to do what's right.
And I think for me, I felt better going in representing myself and
Yes.
telling my story, and that person got to know who I was, as opposed to having this attorney coming in on my behalf because you've already burnt me.
Yes. Yes.
So with can you explain the role of the reverend? You did give a brief background on what you did. What are some of the common mistakes that you find with small businesses and people, individuals applying into this? I mean, working with the IRS and taxes and all of that. What's the common mistakes? Let's start with businesses.
The common mistakes that will definitely land you in collection are not looking at your tax return. You know, math errors account for, there are millions and millions of math errors made. That can trigger an audit.
Mm,
A lot of people don't realize that. But that having perfect numbers. So let's say you have this business investment that you went into uh, that's educational based, and you want to write off that startup cost.
mhm,
Your startup cost, let's say, is $27,329.50.
mhm,
The mistake that people make is they'll say 28,000
mm,
or 27.5,
mm,
something that's a wild number, but it's so nice and round and perfect
mm,
that catches their eye. And they have computers that actually go, now they're algorithms, but they go through. But then they also got the people. The people are the auditors.
mm,
Another error that I find that a lot of people make is not reporting all of your income.
mm,
If you have even non-taxable income like VA disability,
mm,
if you have that, it is still reported, but it is not counted as as part of your adjusted gross income. So even if you do have non-taxable income, or if you have gambling winnings, report it. If you don't know how much you won, even if your losses are greater, the beautiful thing about reporting gambling winnings is that you can also report the losses.
Mm,
So even if you got to go to the casino and get that 1099-G,
mm,
get it.
mm,
Um, not claiming your dependents like you should, or over claiming on your W-4. It used to be on your W-4, you could do single and 10.
mm,
They amended that W-4 now so that it's not as easy to go single and 10 the whole year. And
mhm,
then at the end of the year, you're down to single and zero. You're still gonna owe, depending on your income. However, um, it used to be that people would claim single and 10 for the first 6 months and then single and zero for the last.
I did that. Yeah, I
I
played
I,
the
I
game.
think we all have.
I played those games. Um, mm. So how many? Let's say, as an example, a small business owner, and a lot of times, and I say myself as well, I don't necessarily, when I was married, had the husband all in the business.
Mhm.
But we're still married and still filing taxes together.
Mhm.
What if I don't know what's going on in that husband's business? And how does that affect me if I'm married to him?
So I have a personal accounting of what happens to you. While I was working for the IRS,
Mhm.
my ex had a second form of income I knew nothing about. I filed my taxes. I can tell you the year. It was tax year 1992. But they didn't get a hold of me until this letter came in 1994.
Mhm.
$800 in unreported income.
Mhm.
I worked for them. So when I found out, I'm like, oh my gosh, I know how they are about us paying our own bills timely. I know how they are about us having delinquent debt because we can't collect from you
Mhm.
ethically if we are dodging, the repo man.
Mhm.
So what happened was I got the letter. I went directly to my supervisor, told her, made a payment arrangement to pay it off in two payments. They want it all at once, to be honest with you. But you have to keep in mind an unreported income, if it affects your bottom line and you got a refund, they've paid you $800 too much, plus the penalty and interest. So you
So
still.
how was they able to find that unreported? Were you doing separate taxes? How did they know that that was extra money that you hadn't reported?
So what happens is about every couple of years, it may be sooner. What happens is in 2 years, Social Security, any employer, any interest income, any type of income you have that meets a certain threshold is reported to the IRS. They
Mm.
balance it against what's on your tax return.
See, we don't even know those two are working together. Okay.
Yeah, yeah. And then Social Security computers also talk to IRS computers
Mhm.
because a lot of times they withhold FUTA or SUTA from, they don't withhold it, but they pay it. So if they pay it on this tax ID that ends in 6789 and 6789 has not reported that they have this income over here or they underreport it, it'll trigger a computer audit.
Mm. Mm.
And then
Mm,
they go through the rest of it. And what I mean by audit in that sense is they're comparing apples to apples.
mhm.
So
And
that's
I
something.
tell people that you can't lie to the government. They got things
Mm-mm.
that we can't that we don't have access to.
Yes.
And often in our community, it's surprising where you'll hear people saying, "Well, I haven't filed taxes in 7 or 8 years." Can they legitimately not file taxes?
Not,
Are there any circumstances where you don't have to file a tax return?
yes, there are certain circumstances, and those circumstances are individual threshold amounts, like if you're not working and let's say you made $550 from watching your neighbor's kid for the weekend, or something of that nature, that is less than the threshold amount of 600. So you don't have, and that's your only income for the year, you don't have to file a tax return. Um, if all of your income comes from, let's say, Social Security, you don't have to file a tax return as
Mm,
long as you don't have another income source, such as a job, or self-employed. You don't have to file a tax return because that's non-taxable income. You're actually collecting what you paid in
mhm,
at that point. Unemployment is taxable.
mhm,
So you do have to file one for that if you receive over again a certain amount.
mhm,
So, but in most cases, you do have to file a tax return. And if you haven't filed in 7 or 8 years, trust me, it's just a matter of time, whether you're a business or whether you're an
mhm.
individual. It's just a matter of time before you get um some knocks at the door or letters in the mail. Someone has a question about child support arrearages. What do you mean about child support arrearages?
You can unmute yourself.
Oh, okay, thank you. While we're just asking questions, my ex-husband never paid me child support, and I had a case in DeKalb County with him that he dodged. So he actually owed me over 60,000, but he recently paid me 20,000, and I agreed to that. So
Mhm.
does that negatively impact me? I guess, did I make a mistake by accepting
No,
that?
child support is, again, thank you for bringing that up. Child support is non-taxable.
Oh,
Mm,
that's good to know. So then I just put it on there, I guess, my personal that it was child support, or I mean, I have the paperwork and the documentation to
Yeah,
explain it.
if he gave it to you directly,
Yeah, he gave it to me directly.
okay, so you know that answer. But if it came from the courts, then you would need to somehow annotate it. I can't remember the exact lines where it's non-taxable income, but yeah, it's not taxable at all. I believe that's part of that little area where it says interest from businesses,
Okay,
spousal support. I think it's a little line in there, but child support is not taxable.
mm.
thank you. Good to know.
You're very welcome.
And so often I work with, at least when I was a sport counselor, I had this young man come in and he was trying to get a business loan. And he's telling me, well, I do cash and carry. And I was like, young man, please don't tell that to anybody. um, but I mean that's real. That's real talk. That's how a lot of times in our community we operate that way. um, but I don't know in the end if that will ever catch up with anybody because it's just cash. Who's going to know?
So I'll give you a better example. Drug dealers.
Mhm.
Now we got FinCEN, we got all of the other federal agencies that when they make a major drug bust and they might find $1 million in the house, That's
Mhm.
income. That drug dealer eventually gets taxed.
Mm.
And, um, oh,
Mm.
okay. I was reading and trying to read.
I got the questions for you.
Okay. Okay.
Mhm.
So anyway, that drug dealer eventually gets taxed that money
Mhm.
along with, going to jail or whatever. They do get taxed. A return is filed for them.
Mhm.
And anytime the IRS files a return for you or your business, if it's individual, they hold you at single and zero. Whether they know you're married or not, they're going to file one for you. And if you're married, one for your spouse at single and zero.
Mhm.
It then that triggers an amended return because once they do the single and zero based on your income, then they're going to send you letters. Okay, you owe us X amount for tax return for this. So the same thing for businesses as well. They won't look at you have a business rental or you're paying for storage somewhere. They don't look at any of those deductions. They do a clean, down and dirty tax return.
Mhm.
Yes.
All right. I have one question. It says, what if your spouse collects Social Security and you file joint return? Doesn't that spouse have to report his Social Security on the joint return?
They're supposed to. Um, Again, I haven't looked at the lines in a long time, but Social Security is non-taxable income. So there is an area for non-taxable income on the return. And they want, if there's any funds due, that is not counted in your total, what they call AGI, adjusted gross income.
Okay, great question. Yeah, so often when businesses are starting out, and I guess uh, I'm sort of like that too. I've always understood, again, they're taking my tax dollars out. And just like everyone else, you're trying to minimize your tax liability.
Mhm.
And so often small businesses will start out and trying to take a loss. But then they get happy because that loss, if you're, based on that entity, is passed through you. Is that common? And how long can people claim a loss without IRS coming and saying, this is just a hobby?
So is that loss with some income coming in, or is that loss without income coming in?
That's with some income. You're starting out,
Okay,
that first year. I got
okay.
$10,000, but I'm claiming at least $12,000 in expenses.
It's a case by case. The first few years you're good. Businesses and the IRS they did, because it's been almost 30 years since I worked for them, but um they did understand the fact that you're scaling for the first 5 years. So
Okay.
they look at a loss.
Mhm.
Um, but if your income is 100 and you lost 100,000,
Mhm.
you might trigger an audit even in your first year.
Mm, mm,
Because how can you lose $100,000? I'm assuming you would be a corporation to get that kind of money or an LLC for startup costs, but you only made 100 for
mm,
the entire year, or even 1,000. It's a scale, so you have to be real careful. The beautiful thing about corporations is they can carry forward losses,
mhm,
but that sole proprietor can't.
mm,
LLC can't
mm,
unless they're treated as an S corp. But a single member LLC can't.
mm,
So it's a fine line, but the typical thing is 5 years. The typical time is 5 years.
mm,
After 5 years, if you're realizing more losses than gain or net profits, it might be time to revisit shutting your business down or another avenue of scaling your business.
Um, we have one other question. It says, how about taxes on contracts won and paying the taxes based on the state the contract was won in? Is this correct? And why is this the case?
Okay, taxes based on contracts won. First and foremost, I'm not a tax attorney, so I got to get that out there in case somebody's or
Correct.
IRS.
Yeah.
But
This
tax,
is in your opinion only.
yeah, in my opinion, taxes, federal taxes, the laws can also vary from state to state. Okay.
Oh.
State taxes, and I'm hoping I'm answering the question. State taxes, if the state of, let's say you won the contract in the state of California, but you're realizing that income in the state of Georgia, you're going to pay taxes in California and you're going to pay taxes in Georgia.
Wow.
Yeah.
Did that answer your question, Ruby? You can unmute.
Yes, it did. So I have to pay federal taxes in California and in Georgia?
No. You have to
Oh.
pay state taxes. Federal taxes, the tax laws vary. So I really can't answer
Right.
just definitively about your federal tax question, but definitively I can say taxes vary from state to state when it comes to their state tax laws.
Okay.
Yeah, so if it's in another state, some states you don't have to, but
Mhm.
I don't know what states they are.
Okay. So
Which is in
okay. So I have to make sure my accountant is aware if she's not.
Yes, your accountant or even consult a tax attorney.
Okay. All right. Thank you.
You're
Yeah,
welcome.
because I do have small businesses that have won contracts and they may have employees located in multiple states.
Mhm.
So again, you're right. Every state have their own rules and regulations. I know here in the state of Maryland, me just being the only employee under my entity, because I'm a LLC acting as a S. I mean, the states are ruthless as well.
Oh yeah, that's one thing I can say to everybody. I can speak for California, and it's been a long time since I worked in Georgia. But one thing I can say is California, if you owe taxes today, in 5 or 6 months, they're like, okay, you owe us. You owe us. Did I say you owe us? You owe us. Then in another month or so or two, they're levying your wages. They're putting liens
Wow.
depending on how they don't play. It's like
Wow.
I'm more afraid of the California Franchise Tax Board than I am the IRS any day.
Mhm. Wow.
Yeah.
Wow. This is interesting. This is good. Good information. And although it's been a while since you worked in that position,
Mhm.
I understand it's still the same system, the same process. They may have tweaked it here and there, but the
Yeah.
steps and the processes are the same.
Yes, they have become a more kinder, gentler IRS. And I actually worked I don't know if some of you, I'm dating myself, but years ago, there was this special on TV or one of the news channels about how the IRS is so ruthless, blah, 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 blah. I worked in that district office that they were mainly speaking of.
Mm.
And I knew some of the revenue officers that they got awarded based on how many seizures they did or how many not levies, but liens they file, but mainly the seizures.
Mm, mm. Yeah, I just say everybody's scared of the IRS, but I will consistently say, after their experience of having that debt, my understanding is they just don't want you to run from them. Talk to them. You can
Yes.
set up a payment plan. Yes, you may have to pay these fees and all of that, but that's the price of America.
I have a
That's
Uh,
question.
very true.
Is-
yes.
Okay, I have a, I'm also a realtor, and I recently was referred a lady who explained to me that she was involved in some sort of banking fraud with a group of people. And this was, I think, about 10 years ago. She said that when this situation occurred, they indicted about 30 people together, and they all had some type of a banking fraud or IRS charge of, it was like over 200 or $250,000. But she said the problem is that they put it on all of the people across the board. They didn't give them individual um, a portion. So she said that more than half the people hadn't contributed anything into that, but she and a few of the other people every year they've been working and getting their lives on track. I can't remember if she said that part of that was any sort of incarceration, but essentially it happened over 10 years ago. She's at a point, she has a trucking business. She's doing pretty well, but because that is on her, she can't get a house. She says that they take her tax return and a few other people, half the people she can't get in touch with. But she's been in a payment arrangement and she pays, I think she said like 185 or $200 a month on this. But because of that arrearage, she still is not, you know,
Eligible for anything.
yeah, is there any? I've never heard of that in all of the cases or situations that I have heard. I've never heard of them assessing people as an entire group. And
Mhm.
I don't know if there's any way for her to take
Right.
her portion out and be individual so she can at least pay it off at some point and get her life together. I've just never heard of that.
So, okay, so 200 and some odd $1,000 and 180 something dollars a month, it'll never be satisfied. That
Right.
doesn't even cover the interest.
Mm.
So IRS does assess people as groups. I'll give you an example. If you own a corporation and all of the officers of that corporation that have the authority to make decisions or sign checks,
Mm.
they can be held liable
Oh.
for one tax debt of that corporation.
Mm.
So that particular thing with the banking, they're gonna treat it based on everybody that profited from it.
Mm.
So the only thing I can recommend to her is to find as many people as she can that is involved, that's not paying. She can actually sue them for the share that she has paid. Now, in terms of buying a house, um, that's gonna be a little sticky. She may have to, I don't know if she is married, but maybe her spouse can buy the house, put it in his name totally. And then perhaps, quit claim it. I don't know. Quit claim a portion of it or whatever. But
Okay, so then she would have to sue, find all those people, try to portion it out, sue them directly, but then she might never be able to collect on them. But so you're saying that there's no way the IRS, after 10 years or more years, will reconsider and let her separate herself from that group? They just won't do it.
so it doesn't matter how long, but what I will tell you is this. There are what they call ASEDs and CSEDs, ASED, CSED. ASED is an assessment statute expiration date or statute of limitation for an audit. That's 3 years from the due date of the return or from whenever the return was filed, whichever is later. C said is a collection statute expiration date. The IRS has 10 years from the date of assessment to collect. That means start collecting. That doesn't mean to collect at all. Most of the time when they do a payment arrangement and it's close to that collection statute expiration date, they won't even entertain an installment agreement unless you sign a waiver. If you don't sign a waiver, it's no-go.
Okay, so what does that mean? She's not eligible for that 10-year collection stature because she's been making payments all along?
No. Again, this collection statute expiration date
Uh-huh.
is 10 years for them to start collecting. Is for the
Okay, so they
IRS
have
to
a
start.
okay, so then they're saying that, let's say you owe $1,000 and it's 2024, you owed it in 2014.
Mhm.
Then they have 10 years this tax year, and then if they don't start collecting it within this 10 years, then if they don't collect it till next year, I guess I don't understand.
So let's say you filed your tax return and you had a balance due in 2014.
Okay,
IRS has until 2024, 10 years from the date you file that return to send you the first letter.
okay,
But most of the time, they don't wait that long because there is the computer monitors for what they call the CSAID date.
mm-hmm,
Those become priority for collection. If you blow a CSAID and if you had, as a RO or revenue officer, if you had a case in your hot little hands and in your caseload that had a CSAID that was going in less than a year, and you let that CSAID blow, that's termination. So they monitor CSAIDs real close. As far as paying taxes, however, which is what your friend is doing, there is no, she could pay that the rest of her life. It's just like paying life insurance. You're paying it for the rest of your life or, whatever. And
Wow.
even when she dies, they can go after it in her estate.
oh, wow.
Mhm. That's why if you've heard people say, oh, they can't collect for me when I'm dead. Yes, you can. Yes, they can.
Okay, so she does have, I know that she does have a house. Her name is on a house with her son,
Mhm.
but her son, from my understanding, it's his house, but somehow I don't remember if she co-signed or something for him before the situation occurred with that banking situation. So I guess, but she can't get her name off of that house now. Would she be able? I don't know.
She owns a mortgage until that mortgage is paid if she co-signed, because I
Yeah,
do financial
mm,
coaching.
right.
Um,
I need to just have her call you because I don't
Yeah.
really know how to help
And
her.
I have one more other question.
Go
Someone
ahead.
else needs that wanted to ask. That question was, how about the employee retention tax credit? They said we filed in February, used our payroll company, paid them in February 2023, still no refund. Any idea why this takes so long when our IRS is staffed up? We owe 10K from 2021. We hope to use the credit to pay this bill. Will IRS deduct that from the credit or should we pay and keep waiting for the credit?
so did you have a refund on that 2023 when you filed in 2023?
We're filing our 2023 taxes now, so they're not finished. Hi, everybody. This is Myra Brown from M1. And Ms. Watts, thank you for really being thoughtful about these webinars. They're so helpful to us as small business owners. We adore you. I just wanted to say that.
Thank
Um,
you.
yeah, so we're in the midst of filing for 2023. We did have a refund for 2022.
Okay,
And we paid that towards our bill. So our bill is a little bit, it was more than 10,000. Now it's 10,000. So we used our refund to pay it down. It was 14,000 and we still owe 10. So my questions, I have two questions. I don't know why this employee retention tax credit is taking so long. I've read that it's taking a year, anywhere from 8 months to a year. It's been a year. You know, we put out 4,500 with our payroll company. I have two businesses. I have a recruitment placement business and a construction business. So we had two of them and we're still waiting. So we've put money out that could have been sitting in our account earning money for us. And our payroll company can't even do anything. But more importantly, I don't know if maybe they're looking at that balance bill of the 10,000, if that's what's taking so long, or will they deduct that, or we don't want to start getting penalties. We've gotten a letter, but I think there's a small penalty, but we don't want to continue to earn late fees and penalties. So we're thinking, let's just bite the bullet, pay it. We'll be a little cash poor, of course, and just wait for the employee retention credit. So we're not sure what to do.
so, how long ago did you get the letter?
We just got the letter. We actually just got it about in January from the
Okay.
IRS for the 10,000. We just got it.
Okay, so that's your first letter for the 10 grand?
Correct.
Okay, you got a little time, but what I would do is I would make an appointment or go to the taxpayer advocacy office. And I would take that letter. I would also take copies of the returns that the credits that you previously filed to
Mhm.
show them that you have filed this. Now, to answer your question, will they take that and apply it to your liability? Yes. So the beautiful thing, and I'm saying that term being facetious, the beautiful thing about the IRS is they have this transaction code called TC 130. That transaction code goes on a taxpayer's account and it lets them know, hey, they got an outstanding balance somewhere from us or the state that they're filing their taxes in. And
Mhm.
once they have that on there, any refunds that come in will go to pay that balance. Once it's paid in full, you get the residual.
Okay. And that's what we wanted. We don't want to be cash poor. We wanted it to happen. We just didn't think it would take a year.
Oh yeah, they can, if you file timely, a lot of times it can take 8 weeks or 12. If you file like an extension and then file it late, it can take 6 months. It can take 8 months. I filed a tax return one time. I think it was November of 2021 for 2020. And it took them like till April or May to give me my refund.
Mhm.
So yeah,
Yeah,
So,
and we're seeing the regular tax refunds coming in timely. So those are fine. I mean, our accountant is doing this timely, and I'm trying to keep the accountant out of this part of it because it's so costly. But the employee retention tax credit, I, I don't even know what to say. I mean, it's been a year and a month coming up next month,
go
and
straight,
everybody seems to be waiting.
go
Yeah,
straight
go
to
ahead. I'm
the
listening.
IRS, their employee assistance program. Go to them, the taxpayer advocacy, and help
Okay.
them help you by showing them copies of those returns. They may not have received them or they could have gotten lost in the shuffle. Sometimes that happens, unfortunately. But I would try to cut it off at the head before it goes any further.
so
Okay. Thank
those are your, again, people don't even know they have a resource, just like with SBA, there's a resource to help you fight the government if you need to fight the government. So you said the Office of Advocacy, is that,
Taxpayer advocacy, yes. And then
and
Within that, there's also this, I don't know if they've renamed it, but there's also this division called the Problem Resolution Center. And what they do is they work out problems literally all day. If the taxpayer was double charged, or there's an error somewhere, or in your case, like you file these employee retention tax credits, but in their system to you, they're not reflecting it. So yeah, there's several avenues that you can go right in there in the taxpayer advocacy division.
Yeah, because it seems like even when you try to reach out to them, it you either on the phone for hours, they'll hang up. It's very frustrating. So are these advocates, how are they structured? Is it nationally, or is it, how are you able to find those offices that you can reach out to?
So there are 9 regions in the United States. Within each region, they have district offices proportion. You can go to any district office, just Google your IRS, or even go to irs.gov, look at the locations. They may allow you to search by zip code, or just Google Taxpayer Advocacy Division, Internal Revenue Service, Atlanta, Georgia, or Sacramento, California, and it should come up with it.
Okay, so this has been very good. You all agree? Very good information, Jan. Because again, I don't want people to be fearful of the IRS, just as it is with SBA. We all just have to understand the rules and the regulations and know where to go to find those rules and regulations so that you are in compliance. Anybody else we have about 4 minutes left. Anybody else have any questions that you might want to ask?
Oh, I have one last question. Thank you. Sorry, realtor question again. I have a client who had a lien from the IRS on their home, and they're considering selling it now, but the lien was, I want to say, from the early 2000s, she told me. I can't see it when I pull it up on the on my end, but she said that it was on there. But before she sells her house, she says that she thinks it's a self-release because it wasn't paid. But does that automatically come off on somebody's property?
What happens is there are 2 types of liens. Under a certain dollar amount, there's a soft lien. Doesn't hit the county recorder at all. But the IRS knows about it, and if you try to sell your house, they're going to want their money. But there's also this hard lien that a title search or whatever should pick up. That one is filed at the county recorder. Either way, the tax liability must be satisfied before the house can sell. Once it's satisfied, it used to be, and the reason I say this is because of time. It used to be, once a tax liability is satisfied, I used to do it as a clerk, prepare lien releases. So they will prepare a lien release and send it to the county recorder. But I don't know what they do now, if they do it electronically or what, but it used to be that there's dedicated people that prepared lien releases.
Okay, so she needs to follow up on it on her end. So she said she thought it was something like a self-release after 10 years. No?
Nope.
Nope.
And also, so often we get caught up and don't even understand all of those liens and what point. In that first business, my accountant wasn't paying the payroll taxes, and I didn't know we'd gotten those letters. And I think it was the third letter. We owed them $85,000. They was coming in to actually shut down the business. They have that power. And I don't think small businesses really understand their responsibility when they start hiring employees, all those reports that again has to go through the Social Security as well as IRS. So what's the most important thing that you could recommend as we close that small businesses and you personally um, need to make sure they do so they don't have to have a person like you knocking on the door.
So I'm glad you asked that question. If you have employees, you have the duty to withhold federal income tax, Social Security. You also have the duty to pay unemployment taxes. And you also have the duty to file your returns. Now, these are what they call trust fund taxes. What happens is a Form 941 is filed quarterly for your income tax. The Federal Insurance Contribution Act is your Social Security. The FITW is your income taxes withheld. Those are filed and paid quarterly. Your unemployment taxes are paid quarterly, but you don't file the 940 return until the end of the year, which is due January 31st. So as an employer, I strongly, and this is a little genealogy, I strongly recommend that you keep in your accounts at all times 3 times the amount of your employee payroll to keep the Department of Labor off of your behind, and 3 times the amount of your quarterly taxes. If you can scale that and do that, because what happens is if you don't pay the IRS those quarterly taxes and those annual returns are not filed, they can assess you a 100% penalty. 100%. So if your withholding is 10,000, they're gonna penalize you 10,000. So you owe 20,000. The worst thing about that too is that penalties, failure to pay penalties, and compound interest still accrues on that from the original date that you didn't pay. So be real careful. That's what Ms. Paula was explaining just now. Be real careful for that on business taxes. Also make sure you do not commingle your funds. If the only entity that's allowed to commingle their business and personal funds are sole proprietors. But other than that, if you're a corporation, don't pay. IRS will take your stuff. If you pay your personal electric bill in full from a business account, or you send your kid to the summer camp from the business account, you have just invited the IRS to take your personal funds for business liabilities and vice versa. On a personal note, for personal taxes, make sure that you have your Roth IRAs maxed out every year. Right now,
For them, what is that?
the
You said
Roth IRA is a individual
yes.
retirement account. Now, the Roth differs from the traditional because the Roth is paid with post-tax dollars. So whatever you got left over after your net income, max it out annually. You can, like right now, you can set up one for 2023 up until the due date, April 15th. And you can set up one for 2024. You can actually pay for 2024, not set it up, but pay for 2024. Right now, the Maximum contributions, if you're under 50 is 6,500. If you're over 50 is 7,500 for both years. Max them out. Keep it open for 5 years before you withdraw, and make sure that when you do withdraw, you're 59 and a half. And if you abide by all of those parameters, that's tax-free growth. That's tax-free growth, and that's on the Roth IRA. On the traditional, it's paid with pre-tax dollars, and it has a required minimum distribution at age 72. The Roth IRA has no required minimum distribution. And then lastly, no matter how much the IRS tick you off, don't cuss them out, don't go off on them or whatever, because they have this label that they'll put on your account, and it's called a potentially dangerous taxpayer. PDT. They will put it on your account. And what that means is anytime anybody has to deal with you, they get their criminal investigation division involved if they have to go visit your office. Or if
Wow.
you come in for an appointment. They have what they call investigation that sits right there in plain clothes and you don't even know.
Wow.
Yeah. So, be cordial, no matter how much they tick you off, and no matter how much you want to reach across the counter at them, please don't. And take advantage of your publications. The SBA has links to the IRS. The IRS has how to start a business videos on YouTube. They also have publications for your business, for your personal taxes. One personal tax publication is Pub 17. It's a Bible for your individual income taxes, and it'll tell you everything that you can write off and if you're required to file or not. It helps you. So take advantage of those publications.
And I have one more personal question before we close this out. And I think that's the challenge for most people that are starting out. How do you, what's the best method for people getting paid? If you're not an S corporation and you're getting, I guess, distributions from that LLC, what's the best way to determine and set it up so that you're not owing the IRS?
Well, that depends on a lot of factors. The way first of all, keep copious notes. Record keeping is a must.
So bad.
The best way, even those tedious receipts, don't pay anything in cash because cash is harder to track. If you're ever audited, they don't have to allow it. So to make sure that you are paid properly and calculate your estimated tax payments, there is a Schedule SE. I want to say that's what it is. I'm sorry if I'm looking up, I'm very left brain, so I'm trying to pull the answer down. There's a Schedule SE, and there's also an estimated tax estimator based on what you make. And you pay self-employment and estimated taxes quarterly. The self-employment tax is 50% of your net profit. So if you're not making a profit just yet, you don't necessarily have to file your self-employment tax form, but you should make estimated tax payments.
Well, if you're a small business starting out, you're just barely making it. So
Right.
I wait to the end of the year and make up one lump sum, or is it required that I do something quarterly? Even if I know I'm not necessarily having the money to pay taxes like that at this time.
If you don't have it and you're not making a profit just yet, then don't worry about it. But once you start making that profit based off your P&L, in your income statement, then start making those, use the estimated tax estimator and start making those payments to the IRS quarterly. If you don't, then they can charge you an estimated tax penalty.
Mm. Wow.
Yeah.
And which entity would you say minimizes or has the best benefits as far as a tax liability from
You mean,
the LLC, the SOC corporations, sole proprietor? Because you just said something that 50%, that's a high number to have to pay the IRS.
so that question is really good. It's loaded, but what I will say is this: the C Corp is the best in terms of having a lot of write-offs. They have more write-offs than
Wow.
S Corp. S Corp is the best structurally because there are no pass-through taxation. The LLC, a C Corp has double taxation, I should say, because your shareholders get taxed as well as you when you get a check. S Corp is no pass-through, there's no double taxation. The LLC, if it's a partnership, and the same with the S Corp, your taxes are based on the partner's share, which is a what is that form? It's a partnership form, I believe it's
The
Schedule K.
Mhm.
Based on your contribution, your portion. Let's say you are 30% owner, so 30% of the income and 30% of the expenses, that's what you file on your Schedule K.
Mhm.
70%, then obviously 70%. But the worst one to have is a sole proprietor. That's the worst one. But the other two, you're in pretty good shape.
Well, I think I've gotten my desired questions out. I hope all of you all enjoyed this. Can you all give Miss Robinson a hand? And she's now entering into the third module, contract ready. So congratulations. Just to also recap everyone, we have the information session starting tomorrow. And the self-paced, and then the actual course for this month will start February 28th. Thank you guys, and thank you, Jan, again for providing such insight. And I'm hopefully working with Jan to be able to come up with some type of curriculum that we can offer you guys that's going to help you benefit more as it relates to your taxes. My goal is to pull all of those from the inside that have the inside knowledge come out and tell us the real deal, real talk. So thank you, Jan, and thank you for your service in the military. You all have a happy Friday. Thank you. Bye-bye.
Thank you.
Thank you.